Good evening, everybody, and welcome to our webinar this evening where we'll be talking about stress testing your financial plan. My name is Chris Entz. I'm an advice-only financial planner, a CFP, and a member of the support team here at Advice. If this is your first time at one of our sessions, welcome here. Thank you so much for joining us. If you're back again for another hour with us to nerd out about financial planning, we appreciate it and welcome back. For those of you that are new here, we really want to focus on making these sessions as helpful as possible. So there'll be a combination of going through some slides, talking about some retirement fundamentals, and also looking at some case studies today and kind of really looking at the platform and talking about how to understand it. Please ask questions as we go through things. So stop us, make sure that things are making sense. Ideally, use the Q&A tab at the bottom of your screen to ask your questions, and I'll feed them to Owen as we go through. So thank you so much for joining us, and I'll toss things over to Owen.
Great. Thanks, Chris. Yeah, my name is Owen. I'm an advice-only financial planner, a CFP, and I'm the founder of Advice. Advice, of course, is an easy and powerful retirement planning platform that you can use to create your own retirement plan directly. Now, as Chris mentioned, we do these webinars. So if you're new, welcome. If you're coming back, then welcome back. We do two of these every month. So we do this one, which is more of a case study format. We look at a specific retirement planning topic. We're going to dive into the details. We want to share a bit with you kind of our experience with retirement planning and how to interpret and use the platform. And of course, we also do our office hour session. That's usually earlier in the month where we just answer general questions, go through examples, etc. So if this is your first one, make sure you come to the next one. We'll send out an email for that. Now, in this one, we're going to be talking about how to stress test your retirement plan. Let me just bring up the slides here. Now, if you've been on these sessions before, you've probably heard me say I love retirement planning. I really do. I find it super engaging. When I work with clients on a retirement plan, I find it to be extremely high value financial planning. This, of course, is a huge life transition. So not just a big financial transition, but a big life transition. Lots of big decisions to be made, lots of psychological barriers to overcome. Going from earning, saving to decumulating assets and spending can be a big challenge. So what we want to talk about in this session is how to stress test your retirement plan, but more specifically, and we'll kind of touch on this as we go through, what we're really talking about is where is the flexibility within your retirement plan? So how are we dealing with those stresses? Where is the flexibility? And kind of knowing that in advance before you get into retirement. Um, Now, when it comes to retirement planning, we always want to kind of highlight that this is an ongoing exercise. So we don't want to, really create a static retirement plan. What we're really talking about is ongoing planning, updating every 6 to 12 months, because reality is things change, investment returns, inflation rates, even your own values and goals, your spending will change over time. So you're going to see that kind of reflected as we go through here. Now we're going to touch on a couple of different things. So we're going to talk about finding flexibility within your retirement plan. We're going to be talking about stress testing for investment returns and inflation rate risk. We're going to go through a few examples. So maybe creating upper and lower spending guardrails. Again, talking about risk, but also talking about the flexibility within your retirement plan. And then we're going to talk about longevity risk, the other sort of stress that we want to test for within a retirement plan. Now, as I mentioned, within this sort of conversation, really what we're talking about is finding the flexibility within the plan. So we want to, obviously have that retirement plan. It's built. We've got a, good sort of initial base case, but we do want to stress test it. So one of the things that we want to look at is just how does the retirement plan handle various stresses, inflation, investment returns, longevity, or other things, spending shocks. But we also want to look what happens if there's a positive thing. So how can your plan be adjusted if things go better than expected? So much as we like to always kind of focus on the negative and the downside, there's also the upside potential there as well. So we'll talk about min and max retirement spending, safe and max retirement spending. Flexibility, that's what really turns a kind of mediocre or good retirement plan into a great retirement plan. So you can have a static one-time retirement plan, that's okay. But if you have a retirement plan that you know where the flexibility is and you're updating it on a regular basis, that's really going to be a great retirement plan for you. couple things to highlight here. So as we go through, we're going to touch on some of the fundamentals here first. Then we're going to go through some examples. As we go through the examples, really what I want to try to do for you is interpret some of the numbers, some of the context behind the numbers. So some of the nuance and how to interpret what we're seeing. And when it comes to stress testing, there's three things we want to focus on. Investment risk, that's a big one. That's the one everybody always thinks about when they think about stress testing their retirement plan. This is the risk of losing money during a market fluctuation, a recession, a depression, poor investment returns, also called sequence of returns risk. This is the big risk that everybody always thinks about when it comes to retirement, and we want to address that obviously within the retirement plan. The other one, which for a long time people didn't really think about, is inflation rate risk. So, for a very long time, inflation rates were quite reasonable, very predictable year over year. COVID obviously changed that. And then all of a sudden, it's a little bit more top of mind. But along with investment risk, inflation rate risk is the other big risk within a retirement plan. This is the risk of, potentially having inflation that outpaces your investment returns. Having negative or low real returns means that your sort of investment income, retirement income reduces in purchasing power over time. So that's the big risk here, is that you could have, high nominal returns, but when you include inflation rates, it could be that your real returns are quite low or even negative, and that could be a big risk as well. And then the last one is longevity and survivor risk. So here, longevity, we're really talking about, even for individuals, what's the risk of having a long and healthy retirement? I mean, that's definitely a good thing, but from a financial perspective, there's certainly some risk there that we want to address. You'll notice on the platform, we always default to having a fairly long retirement plan, and that's because we want to test it by just shortening the life expectancy. So we'll talk about that and how to do that. The other big risk here that's connected is a survivor risk. So for couples in particular, there's this additional risk of, what if a partner passes away earlier in the plan unexpectedly? There are a large number of financial considerations on top of all the emotional considerations. So how does that retirement plan adjust, or potentially need to change? Where's the flexibility if a partner passes away earlier than expected? So we're going to cover those three. Let's start talking first about investment risk. So, three key considerations before we get to the examples. The first one is, how well are you diversified? So, when we talk about investment risk, one of the cheapest and most effective ways to reduce investment risk is through high diversification. Increasing diversification can decrease your investment risk. So, we want to understand how high your diversification is. We've obviously worked with clients that have very large positions in individual investments. They've got a large position in banks or a couple banks. It could be employee shares. That's also a thing that we see quite often, is you've accumulated employee shares over 10, 20, 30 years, and they end up being a fairly significant portion of the portfolio. When we look at success rate, when we look at some of the analysis, it's important to highlight that that analysis always assumes that you have a fairly high level of diversification. So the more concentrated your portfolio, potentially the higher returns, but also potentially the higher risk there as well. Now, the other one here in investment risk is there a clear asset allocation? You'll notice in the platform, we ask for asset allocation. That's an important piece of the success rate analysis, is the variability there. And so we really want to understand, what's the risk capacity, the risk tolerance, what risk level are we starting to target, willing to target, and can we afford to take on that much or that little risk within the plan? One of the interesting things about risk here is that having a low asset allocation, a conservative asset allocation, can sometimes actually increase risk. It decreases investment risk, but we'll talk about it next. It actually increases inflation rate risk. So sometimes focusing on one risk can actually increase other risks. And the last one here is the plan flexible enough? So if you're investing, and usually you are, if you have a long retirement plan, you need your financial assets to grow. Is the plan flexible enough to handle down years? So inevitably, there's going to be a correction, recession, depression. How does your plan handle that? It can be very tempting to use asset allocation techniques to deal with this, so cash wedges, more conservative asset allocations. But we also want to understand where's the flexibility in the plan, particularly around spending and or additional income. So sometimes being more flexible and addressing investment risk isn't necessarily through investment sort of means. It could be just through flexibility around income and or spending. Now, any questions before we go to the next risk,
No,
Chris?
not so far.
Okay, perfect. So let's talk about inflation rate risk, and then we'll go through some examples here on the platform. When we talk about inflation risk, really here there's a few things to consider. One, how much of your retirement income is actually indexed to inflation? So CPP, old age security, do you have a pension, a defined benefit pension that's indexed to inflation? All of those things would reduce your inflation rate risk. But if you have a pension that's not indexed, of course, there's a risk there that inflation will eat into the purchasing power over time. So one of the risks with a flat defined benefit pension, flat lifetime payout, is that higher periods of inflation can quickly erode the value, the purchasing power of that pension benefit. So that's always important. In terms of investment options, is it outpacing inflation? So again, being too conservative can be a big risk here where we've reduced investment risk, we're in cash or we're in bonds, but we might not see enough growth to actually outpace inflation, and we actually have negative or very low real returns. And that can be a real challenge for a long retirement plan. And then the last one here, is there flexibility with spending? So one of the ways, again, to deal with inflation rate risk is to understand where is there flexibility with spending? Can we reduce spending in certain areas to reduce the risk there as well? So again, it's not just about the investment options, but the other options as well. Okay, so let's flip over to the platform unless there's any questions. Let's go through some examples and really how to interpret these success rate charts here.
Sounds great. Let's jump in.
Okay, so let's flip over to this example. Let's first talk through some of the numbers. Really, what we want to do here is highlight how to interpret some of these things. I think one of the advantages that Chris and I obviously have is that we have seen many, many retirement plans, probably combined over 1,000 easily. And so we've had a lot of time going through and interpreting and understanding what's driving some of the numbers that we see here. One of the challenges that you're going to have is that you really only see your retirement plan. And so in this sort of webinar, in this example, we want to show you a few different examples. We want to show you how that impacts success rate, flexibility, and give you a bit more of a perspective behind the numbers because there is interpretation here. This is where we get from the sort of math side of retirement planning into the softer side of retirement planning. So two numbers to highlight. So let's first talk about plan funded before we get to success rate. So plan funded is really a measure of how well the income from the plan and the investment assets are able to meet the spending goal within the plan. So here we've got a spending goal, 134,000 a year over the course of retirement. This plan funded ratio is measuring the income sources and the investment assets and how well those are able to meet the spending goal over time. In this case, with a 104% plan funded, we have a little bit of investment assets left over in the end, but not a lot. We are just able to meet our spending goal over the course of this plan. So obviously we want to have a plan funded ratio over 100%. We don't want to be below that because then we definitely have shortfalls. But one of the things in plan funded is that it's assuming this average rate of investment return, average rate of inflation over the course of the plan. Makes a nice chart, um, easy to understand, not super realistic. If you've been investing for more than a few years, you know that investment returns fluctuate quite dramatically year from year, as well as inflation rates. So a lot of financial plans, retirement plans stop here. They do a straight line drawdown. They might show you 104% plan funded, and that might feel great. But one of the things to remember here is that any deviation from the expected inflation rate or expected rate of return could mean that this plan would run out of money. And that's what success rate is trying to measure. Success rate is really taking the exact same drawdown plan, the same asset allocation, the same investment fees, same spending over time, every year, the different spending periods, tax liability, government benefits, and it's running it through historical periods of stock returns, bond returns, and inflation rates. And so really you get multiple paths, and every path here is one historical period. So it's like we've gone back in time. We've started retirement in 1929, right before the Great Depression. And that's what these lower lines represent is some of those more challenging periods for a retirement plan. So could be 1930s, the Great Depression, could be 1970s, higher inflation rates, lower real returns. Both of those periods very challenging for retirees. And in this case, 40% of those historical periods are running out of money sometime before the end of the plan. So 60% have some money left over, could be a dollar, could be $1 million, but 40% run out of money with 10% of them running out as early as age 85. So what we want to understand here is a bit of the context behind the number, the 60%. And we can really look at the visual here as well. We can really understand how many of those lines are running out of money. We can see that actually quite a few are running out of money after age 85. So we might be a little bit less concerned with this 60% success rate because it's quite late in the plan. If this was all happening at age 70, we would be very worried. So as much as we want to focus on that 60% success rate number, we also want to look at the individual lines, kind of where they're going, how many are running out of money, how many hit that x-axis where we have zero financial assets left over. The other thing we want to look at is how spread out those lines are. So the more conservative your asset allocation, the tighter that variability is going to be. The more aggressive you are with asset allocation, the higher equity component, the more upside potential, but also the more downside. So one thing you'll notice depending on your asset allocation is you might have a very tight success rate chart or a very broad success rate chart. The other thing to keep in mind is that the longer the retirement period, the more the variability will impact where these lines go. So here we've got a 30-year retirement, your typical kind of Trinity study 4% rule. But if you're retiring earlier, 50, 55, 60, you might have a longer 35, 40-year retirement period, and that could broaden the sort of variability within the plan. So it's always important to kind of put the context behind that number because depending on the length of the plan, the asset allocation, there could be some sort of nuance behind that. Now, we're going to go through a couple examples here. So unless there's any specific questions about the success rate chart.
I'm gonna let you keep on going for a little
Okay.
while. There's lots of questions about what are good rates to target, but I
Okay. Okay.
know
Okay.
that that's something
Okay.
we're going to talk about a little bit. So we'll
Perfect.
go through that and we'll round.
So let's go through three examples here. We're going to go through what's a good success rate, but we're going to do it with the context of understanding what's behind those numbers. So here, 60% success rate. Seemingly that wouldn't be great, right? We've got a 40% chance of running out of money. 40 out of 100 of those past periods have run out of money before the end of the plan. But we have, if we look at the spending down here, and let's look at personal spending, we have a very large amount in this plan, a very large amount of discretionary vacation and travel spending. So this isn't locked in spending. This is purely discretionary. Um, it's not like they purchased a vacation property or some other sort of fixed sort of expense. This is truly variable discretionary spending. And so a large proportion of their expenses can be reduced if they need to in retirement. And so in their case, a 60% success rate might be just fine because there's lots of room to absorb any of these sort of lower investment inflation rate scenarios. So it's also important to kind of interpret this with the spending flexibility included there. Now, the other factor in this plan, if we look at net worth, is there is some real estate assets. Not a huge amount. It's not like they have $1 million home, but 660,000 or so in real estate equity which could be sold at some point in the future. So if somebody was renting, if they needed to spend all of that money in retirement, then yes, 60% success rate might be a bit concerning. But in this case, we've got home equity to fall back on. We've got a ton of discretionary planned spending within the plan. And so actually 60% success rate might be just fine, especially because really the first major chance of running out of money is at age 85. So that's one example. Um, but let's take a look at another example, unless I should stop, Chris. Okay, let's keep
No.
going. So let's look at this example. So here we've called it the precarious example. We've got an 80% success rate, seemingly quite good. It shows green, right? And that's the case if we have spending that's 95,000 a year. So if this client can meet that spending goal every year of 95,000, then yes, this plan seems to be, quite reasonable. It's got a very good success rate. But if we look at the income assumptions, one thing that we need to highlight here is that a large percentage of their income is fixed. It's pension, CPP, and old age security. So only a very small portion of their retirement spending is coming from their investment assets. And that means that from a success rate perspective, there is definitely some risk if we increase spending. So if we go down here to the retirement spending, let's just filter on spending strategies. The AI strategies are already highlighting this for us because if we increase retirement spending by just $3,000 per year, our 80% success rate drops down to 47%. And again, the reason is there's really not a lot of financial assets in this particular plan to help absorb that higher spending. So this is where, even though the number looks good, the 80% success rate, by using the AI strategies, we can quickly see that even a small change in spending quickly makes this plan unsuccessful. So if we were working with a client, we were going through this plan together, we would be very, very focused on what is their retirement spending and is 95 really the right number? Because if the right number is actually 100,000 a year, if that's what they really need to support their lifestyle in retirement, then we've got a bit of a problem because we know that that plan's a little bit less successful. So again, behind that success rate number, we do want to do a little bit more digging in terms of the sensitivity to the spending as well. Let's go through one more example here. So our conservative example, um, it can be very, very tempting on the platform to aim for a 100% success rate in the success rate analysis. However, that can also mean that you end up with a lot of money left over at the end of the plan. And in this case, we're actually spending so little relative to their assets that we see that their financial assets actually grow over time. So as much as we have a 100% success rate, and that might feel good, we are probably leaving a lot of money on the table in this case. And again, we can take a look at the AI strategies here. And so we can already see, even if they increase spending by 24,000 a year, it's still 100% successful. Only until they increase spending by 30,000 a year or more do we start to see the success rate drop. So we'll kind of go through some examples next on how to create different guardrails for spending. But again, aiming for 100% success rate might mean that you're not getting the most value out of your retirement plan that you could. Go
I
ahead,
think I'd
Chris.
just like to add that this is where the goals for your retirement matter. So if you're somebody that really is trying to prioritize leaving an estate behind or maximizing kind of what you're leaving behind, when you look at a scenario like this, you say, well, I'm reaching my goal spending, it's successful. That might be exactly what you'd like to do. But if you're looking at trying to balance the sense of spending and enjoying your funds in your early retirement versus longevity risk, this might mean that you're being too cautious in the sense of chasing that 100% success rate. So again, like Owen said at the beginning, what you want from your retirement also is a really important factor in interpreting these success rate numbers.
Yeah. And even working with a client, we would probably have the conversation about, even if we don't need that spending for retirement lifestyle, are there gifts, charitable contributions we could be making, gifts to family, could be helping them maximize their first home savings account, TFSA accounts. We might be having additional conversations about can we better use those assets over time? So again, the plan's fully funded. We have at least 24,000 to 30,000 a year in additional kind of outgoing cash flow that we could be using. What's the best way to get the most value out of that? So yeah, go a little bit deeper behind the numbers to interpret and understand what's driving that. Now let's go through an example. Let's work through an example here together about how to create some spending guardrails. Unless there's any other questions, Chris, we should address.
Well, let's pop into that and then we'll talk a little bit about some numbers.
Okay. So in this case, we've got a plan 78% successful. They're 108% plan funded. So overall, quite good. We've got fairly good retirement spending here. So they're spending 152,000 is the goal until 75. Then we've got 122,000. Then we're down to 107,000 in late retirement. So lots of room there for spending, definitely above average for a couple in retirement. But the question here is this the right number to aim for? Should we be aiming for a different number? Maybe they're uncomfortable with a 78% success rate. Maybe they're looking at these lower lines. They're looking at that higher spending in early retirement, and they're sort of saying, oh, shoot, like, even a 10% chance, I'm not comfortable with running out by age 74. So what can I do here to make this plan more successful? Um, in those worst case scenarios, we're talking about 22% of the time, 1 in 5 historical periods. So let's make a copy of this and let's find a safe level of return. So we have a good target. That may be what they want to target there. But let's call this safe spending example. And what we're going to do is we're just going to use the AI strategies to evaluate this. We're going to be looking for somewhere close to 100% success rate. So again, this isn't going to be the main plan because we know most of the time they don't need to do this, but we want to have that fallback, that safe level of spending. So let's take a look. Increase retirement spending. We want to look at decrease. And so 3,000 is not enough. That only gets them to 83% success rate. Reducing spending by 6,000 is pretty good, 92%, but still 8% of chance of running out of money. It seems like reducing spending by 12,000 a year is all it would take to get this plan to a 100% success rate based on historical stock returns, bond returns, inflation rates. So if we enable this strategy and rerun this example, now we've got a 100% success rate. Even on those worst case historical periods, they can still spend that, in this case now 140,000 a year in early retirement. Still a very generous number for early retirement spending. And it very much solidifies for the client that we don't need to go lower, right? The temptation can be, oh shoot, we've hit a recession. I need to cut my 152,000 down to 130 or 100,000 or something extreme. The fact is, in this example, we don't need to do that. Now, every situation is different, so you need to do this for your particular retirement plan. But this is a great thing to sort of tell the client because we know even in the worst case historical periods, reducing spending to just 140,000 a year will make this plan more successful 100% of the time based on historical results. So that's a great sort of safe level of retirement spending. But we want also what's the max spending this plan could support. So let's go back to that target. So again, here we had 78% success rate. Spending was fairly generous in early retirement. How much higher can we push this? That's the question. There's definitely money left over here at the end, a couple $100,000. So how do we spend more of that? What's the maximum that we can spend within this plan? And so again, we'll use the AI strategies. And this time we're going to rank by higher spending first. And we're just going to go down and look for something maybe close to 50%, kind of that would give us close to 100% plan funded. So let's find out where that is. So we can increase spending by 3,000 a year. We'd hit 60%. Could do any of these go-go ones, or we could just increase spending through the entire plan by 6 grand. So if we do this, we drop success rate to 52%. We know we can only do this half the time based on historical periods, but it does give us a better upper bound for retirement spending. And here, success rate or plan funded is 100%. So now we can spend most of the money half the time over the course of this retirement. And we do have a good sense of where the max is for this plan. So we know the min was around 140. We know the max is around 158. That gives us a good $18,000 range to work with. Your plan might be different. This plan, I think, has some pension income, which changes it. If you've got a lot of investment assets, that might be a wider range. Could be plus 24 and minus 18. So do this for your own plan because you want to have your own set of guardrails. But in this case, we've got a good success rate. 50% of the time, we can definitely spend this amount of money. Um, the other 50% of the time, we might have to go down to that target spending or maybe the safe spending level. But again, even half the time here, we still have a lot of money potentially left over at the end, 200, 400, 600,000 plus. So there might be even more room as we update this plan every year, depending on investment returns. Any questions or comments so far, Chris?
Yeah, there's some stuff that's worth kind of coming through that I think is so quite a few questions about what number should we be targeting. So we talked a little bit about the success rate side. They also kind of questioned about what plan funded number should we be
Mm,
targeting. And so I think it's worth highlighting that in this scenario, 100% is usually needed in order to not show shortfalls in your plan.
yeah.
But then there becomes some variance. Is that the case?
Yeah, exactly. Yeah. So at a minimum, we'd want to see 100% plan funded. The problem there is that any deviation from those expected investment returns or inflation rates means you'll run out of money. So it's probably not a great target. Most retirement plans, in terms of like target spending or safe spending, we want to be above 100% plan funded. And probably around 70, 80, 90% success rate. But again, depends how much discretionary spending, how much flexibility you have in your plan. If you've got a cottage, vacation property, rental properties, if you've got a large home that you can downsize in the future, it's important to highlight that this success rate analysis doesn't include any real estate assets, and it's purely the financial assets. So if you're willing to, sell or liquidate or access some of the capital in those real estate assets, that could also change things as well. So yeah, I would say it is a little bit open to interpretation. Um, for plan funded, we want to be above 100% success rate. Generally for, sorry, plan funded for success rate, generally 80% or more is good, but you want to highlight, what's the max spending as well, and what's a reasonable sort of upper bound. And in this case, we can target this level of spending until we see this net worth decline below these values. If we're still above these net worth targets every year or financial assets, if we know that we're not in some of these lower scenarios that run out of money, we can still confidently spend that same amount until we start to dip below it. So use this as a guide. Obviously, update the plan every year. Your spending goals might change. You might need to make a one-time expense, a gift. So things always change outside of investment returns, inflation rates, but evaluate that plan every year.
Yeah, I think just to kind of say what you were highlight what you're saying there as well is to say you can target a lower spending side, but we'd like you to check in often. And just to, in terms of tracking, we have a couple of questions on this idea of tracking. What am I actually looking at? So
Mm,
if you come at your plan next year and you say, hey, where are my balances at compared to what I thought the plan would be? Am I 10% lower than that? Am I where I'm expected to be? Am I above that? That can tell you a lot about, do I need to shift from those spending targets? Do I need to go closer to that safe target? Or can I afford to keep on looking at my max targets?
yeah, that's right. So in this example, we're starting retirement 65. We got 1.1 million in financial assets. Um, if next year we're trending down to 800,000, yes, we should be worried because that is definitely in one of those extreme periods. If we're down to 700,000 here, then certainly we want to be concerned. So if we're anything above, in this case, it would be around $1 million, and we can even see it in the, so by the end of that year, we're at 989,806. As long as we're at or above that number, check the box, first year of retirement's done, everything's successful, rerun the plan, because we also want to, sometimes spending changes, right? Just the inflation rate alone, everybody's spending can change differently than inflation. So you might have different spending than somebody else. And So you definitely want to update the plan, but that would be the first check that we want to see is did we finish the year with 898 or more? Sorry, 989 or more? If we did, perfect. Then we're sort of on track for that first year.
And just a clarification, so for the 10th percentile, does that mean that it's the worst case scenario for the entire retirement on that line or just the starting portion?
Say for the 10th percentile line. Yeah,
Yeah,
that's
so
sort of
when
the worst 10%. So it's sort of ignoring the outliers, right? So we think about like normal distribution. We've got these extreme outliers on either side. What the 90th and the 10th percentiles are trying to do is maybe not have you focus on, this line way up here that has 1.6 million, because that is an extreme example. So the 90th and the 10th percentile are just trying to focus, narrow your focus just a little bit to ignore those long tails of the distribution.
but the historical lines themselves that they're using are like you're getting dropped into 1929 and then living 30 years from that point. So it's not just taking the worst 10 years and then ignoring what happens in the next 2 decades. It's
Right.
following that
The
historical
whole
pathway
period.
all the way through.
Yeah. Yeah. It's like you've gone in a time machine, you've taken your 1.1 million, you're in 1929, and bam, the Great Depression hits. That could be more challenging. Yeah.
So another question here. So if you're trying the die with zero strategy,
Yeah.
we had a really great term for that the other in our last webinar, and I've forgotten what it is already. Oh, frustrating.
Anyway. Yeah.
What success rate should you be aiming for? Is it around that 50% point?
Yeah, usually that's what it is, because that would be average investment returns over that period based on your asset allocation, fees, etc. So 50% is probably good to target, but again, this is where we need flexibility, because even a 50% success rate means that 50% of the time there could be a lot of money still there. So I would say, as you're updating the retirement plan, in this case, if we were at the 1 million or 1.1 million mark, 3, 4, 5 years into retirement, we could be in those best 90% of cases. We could be in the best 10% percentile, and maybe we can spend more than what that original die with zero plan had. So yeah, the key thing we want to highlight in this webinar is that as much as you can start with that initial retirement plan, you can have your kind of safe spending level, your target, your max spending level. Reality is 6 to 12 months later, it's going to be different. It's going to be different because you've locked in one period, 1 year of retirement. Maybe you can spend more. Hopefully that's the case. Maybe it has to be a little bit less. Maybe if we've hit a recession, depression, but you'll have a good sense of like what's the range that you're aiming for.
Next question. So this is more of a feature request perhaps, but is it possible to see the portfolio value numbers for the 10th, 50th, and 90th percentile of every year for a given plan? Those would change with time, but having numbers would help calibrate the where am I as you go.
Yeah, we could. Yeah. I mean, we did make a conscious choice of not having hoverovers for these because there just are so many lines. It's really not the point to follow individual lines. Again, the idea was more to understand the breadth of how kind of, how variable the retirement plan is. But yeah, for the 10th percentile, 50th, 90th, it's definitely something that we can add. So yeah, we'll take that away back to the team. We'll see if we can do something there. But yeah, in general, you know, especially 5 to 10 years out from retirement, those numbers are almost meaningless because you're going to, as you kind of move forward, every year you're going to be locking in, what's actually happened. So this is, kind of reevaluating every year, and as you lock in those results, things are actually, it's going to look different. It's going to change. So again, static retirement planning, very old school. Really, you want to be updating this quite frequently, locking in results and understanding how that plan changes.
A few more questions before we move on. So maybe in that same vein, when we're talking about updating frequently, so we talked about
Mm.
updating annually, but if this person specifically wanted to know about quarterly updates to their plan, what should they update? What's the best way to kind of feed in investment and asset actuals during those
Yeah.
quarterly updates? Speak to that.
Yeah, it's a really good question. So we will be adding more in terms of tracking with some great metrics around like where are you during the year. Um, But for updating the plan, if your asset balances have gone up, we wouldn't recommend updating the full plan. So one of the challenges is that the platform does year by year projections. If you update mid-year, it's going to add a full year of investment returns on that mid-year balance. So in general, if your investment returns are going up, probably wait until we get to that next year point to update the plan. The exception, of course, is if we have a big sort of correction, depression, recession. In that case, yes, update the plan, put in your new account balances in the discovery phase. Um, you can also do it in a separate scenario. So you could always come to advanced options here. You could update these balances for a particular scenario. So that could also work. But if we see a correction, some sort of 10, 15% reduction in portfolio values, you could certainly do an update mid-year. Because again, in that case, having the investment returns for a full year on top of that is probably less of a concern. We're probably more worried about how has this changed the retirement plan. So if we see a big correction, recession, depression, by all means come in, maybe do it in a separate scenario first, just so you can keep your original scenario and you can see the sort of market correction side by side. The reason I say that is like even this year we saw 10% correction, 10% plus, now we're back or above where we started. Um, we don't probably want to redo the whole plan. Doing it in a separate scenario is probably a good place to start.
Great, thanks, Owen. One more before we pop over to survivors. This is a bit more specific. So they have DB pensions and some investments, TFSA and
Mhm.
RSP, and they've noticed that when they stress test to get below 95%, that it's causing them to need to borrow against the house in order to meet the goals. Later in retirement, that goes back up. So I think they're seeing some debt in the interim, and then it's kind of disappearing later in retirement. Is there a way to tell the system to not eat into the real properties?
Yeah, okay. So that situation can happen, especially if you reduce, if you've got 3 periods of retirement spending, so like go, go, slow, go, no go, if you're, and this is very particular to DB pensions, right? One of them, love DB pensions, great for retirement planning. One of the big challenges, though, is that you don't need all that money late in retirement, right? And so, one of the challenges with a DB pension is that you're trying to spend more in those go-go years, um, but you don't have the financial assets to support it. But late in retirement, you've got all this income, and you can sort of recover a little bit. And that's what the platform is highlighting here, is it's saying, you know what, if you really want to maximize spending in your go-go or slow-go years, and you've got a big DB pension, it's sort of highlighting the fact like, yeah, you can recover some of that shortfall later on in the plan. There isn't a specific way to do that unless you just reduce your retirement spending within the plan. So right now, what the platform is essentially telling you is that if you're willing to tap into home equity for a short period of time, and it's realistic that you're going to drop spending after age 80, 85, or whatever you have in your plan, you could recover that home equity line of credit, whatever you're borrowing against, you could recover that with your pension income. It does happen. It's one of the downsides, I guess, of a DB pension is that it doesn't give you the flexibility to spend more in early retirement, and it sometimes gives you too much money later retirement.
Yeah, it kind of was the same thing when we were looking at that precarious 80%. Less
Yeah,
flexibility, more stability, less flexibility kind of across the board.
yeah. So it's a personal decision. Some people would be fine with tapping into home equity for 5 years, knowing that at age 80, 85, they're going to reduce spending and they're going to go recover that amount. But yeah, personal choice.
Right. Well, let's pop into the survivor side. There's a couple of more general questions that we'll see if we can get to by the end.
Okay, great. So let's go down here. Just going to pull up the slides. So let's talk through a little bit around longevity risks, survivor scenarios. This is a table from FP Canada. This shows the survival sort of percentage probability. This is an interesting table, so I want to spend a moment on this before we get to some of the examples. What it's saying is that if you are at age 65 today, you've got a 25% chance of living until your mid 90s, and maybe a 50% chance of living into your early 90s or late 80s. Now, for couples, it's interesting. That longevity number is a bit higher because this is where one person in the couple is living potentially a little bit longer. So because now there's two people, there's actually a higher probability that you're going to live a little bit longer. One person in that couple could live a little bit longer. One of the very interesting things about this table is that it does not represent average life expectancy across the entire Canadian population. This is actually a subsect of the Canadian population. I think they call it the pensioners probability survival table. The reason why actuaries and FP Canada use this table in particular is because if you're on this call, if you're thinking about retirement planning, if you've got significant financial assets or a DB pension, the reality is that you've got the resources, maybe good health, good financial health, physical health, mental health. You might have a longer life expectancy than the average population. So this is usually what we want to focus on when we talk with clients about life expectancy and probability. We don't want to use average life expectancy for the entire Canadian population. And when we think about longevity risk, there's a couple things to highlight. Um, by default, again, we are planning for a long and healthy retirement. So on the platform, you'll notice that we are typically by default looking at age 95 or longer. We can always shorten that life expectancy using the AI strategies. But by default, we do want to make sure we don't run on money late in retirement. So saving enough, understanding spending, that's an important piece of dealing with longevity risk. We can always adjust for shorter lifespans. So, as much as we want to test for longer and healthier life expectancy, we also want to test for shorter life expectancy as well. This is to balance the fact that we don't want to oversave. So, we don't want to oversave. We want to understand maybe what sort of strategies change with a shorter life expectancy. Delaying CPP is great if you live until 95, not so great if you live to 75. So, this is where having both scenarios can be very insightful. And then, of course, the last one is stress testing for the loss of a spouse or a partner. So if you lose a partner in a couple, big financial impact, big emotional impact, but huge financial impact here as well. So we want to stress test against that loss. And we'll talk about that next. So when we think about the financial effects of losing a spouse or partner, there's actually quite a few. We'll see a loss or reduction of government benefits, different impacts for CPP and OAS, possibly a reduction in a defined benefit pension. So depending on the choice you make for survivor benefits, it could be a large reduction there. One of the challenges is that we lose income splitting ability as a couple, and we lose some tax credits as well. We have the rollover of all the accounts to one individual. So if we've got a really big RSP account, RIF account, LIRA LIF account, that can be a lot of registered assets for just one person. And on the plus side, sometimes we get a payout of an insurance policy. The downside there is that might cause some investment considerations. How do we invest the proceeds? We need it to support retirement spending. Or one of the other challenges is there more tax that gets triggered? And how does that change the plan? So lots of considerations here. For CPP, really, there's a number of different benefits, but the one that we're focused on is CPP survivor benefit. We've talked about this in a previous webinar, so we can always share the details. But there are some different benefits depending on, as a survivor, how old you are. So if you're before age 65, you get a certain benefit amount. If you're after age 65, there is a different benefit amount. And there could even be a third benefit amount because as the survivor, when you start your CPP, you'll notice that there's a combined calculation that could reduce the benefit even further. So often we'll see in a plan, we'll see a pre-65 amount, a post-65 amount, and then a third amount whenever the survivor chooses to start their CPP benefit. The unfortunate thing here is that you can't have more than the maximum for an individual. So often we'll see a sizable reduction in a survivor benefit when the survivor starts their CPP pension. For OAS, there's no survivor benefit, so a big impact there. And the AI strategies are very beneficial when testing or at least quickly evaluating the impact of a shorter life expectancy. So here we can see Sam and Louise, if they have a long and healthy retirement until age 95, 93% success rate, great. And we can see here, though, if one of them were to pass away earlier within the plan, that success rate quickly drops. and it's not the same drop. So we can see here for Luis, it's a bit better. For Sam, it's a bit worse. It could be that there's a DB pension for Luis, which maybe Sam doesn't receive the full amount for. So this is a very quick and easy way in the AI strategy table to understand, if you're a couple, the impact of losing a spouse or a partner earlier than expected within the plan. Now let's go through some examples here. So let's flip over, unless there's any other questions, Chris.
Let's pop into the survivor examples, and then we can see what we can get to at the end.
Okay. So in this plan, let's flip over here. So we've got our base scenario. Let's take a look. So base scenario, Kurt and Lori, we've got an 84% success rate, pretty good. We can see there is some pension income, CPP, old age security. Overall, they're spending 107, 108,000, down to 91 mid-retirement, 74 late retirement. Good plan. Definitely some wiggle room here. So we've got 440,000 in a TFSA mid, kind of grows a little bit by late retirement. Again, pretty good success rate at 84%. But we want to understand what happens in a survivor scenario. So for a couple, we're going to actually run four different scenarios. We've got this base one. We're going to also look at a survivor scenario for Kurt here. So for Kurt, we've already reduced spending by 15,000 a year after Lori passes away. But we see some other impacts. So here at age 80, we can see CPP gets reduced. So unfortunately for Kurt, because they were both close to the maximum, we see a fairly big reduction there. For old age security, we also see a big reduction because unfortunately for Kurt, we only receive his benefit going forward. This actually could be an even bigger reduction, but luckily they've drawn down all their registered assets prior to this. So for your plan might be different if there's a lot of registered assets, could even cause OAS clawbacks for the survivor. And then last impact, unfortunately for Kurt, is that Lori's pension gets reduced, only a 60% survivor benefit. So lots of changes within this particular plan that reduces the success rate, even though we've already reduced spending by 15,000. So good thing to understand, especially for couples, what do we need to do to maybe increase this success rate? And we'll come back to this one if we have time, but let's take a look at what happens if Lori were to pass away. Sorry, if Kurt were to pass away. So here, not quite as bad. We can see 75% success rate, same reduction in spending. But of course, for Lori, Lori will keep the entire pension. There's no reduction in the benefits. So even though we see a reduction in CPP and OAS, the fact is that there's more pension income. So success rate's a bit better. And then the last one I want to show you is the joint shorter life expectancy. Great scenario to run. In this case, we can see success rate's good, so we're not worried about that. Really, what we're looking at is how do maybe some of the AI strategies change? And in this case, we don't want to delay CPP. So if there's a real concern that we're going to have a shorter life expectancy, actually might make some different changes within the plan. And you can be flexible about this. Talking about flexibility, if you start retirement at 55, you're not really making that CPP decision for another 5 years at a minimum, or maybe more. So if life expectancy, health changes, you can also revisit that decision at any time. But in this case, we already know starting CPP earlier, if there's maybe a shorter life expectancy all of a sudden, would probably be the right decision for them. Should I stop there, Chris, or any questions?
Yeah, do you mind just showing, somebody was curious about how expenses are changed on the death of a spouse? So I know that we lowered them. That doesn't happen automatically. Can you just show how we would do that?
Yeah, so we want to come down here to the table. What you can do is usually we'd recommend just doing it in other expenses, and you can add a negative. So if you open up the other expenses using the arrow, any of these values in blue can be overridden, and you can just add a negative spending adjustment. So this will reduce the total spending. And of course, the survivor would need to figure out where does that come from, what personal spending gets reduced. But from a planning perspective, just as it gives a quick way to test what a reduction in spending, what sort of reduction is necessary. So quick and easy. If you're looking at the help resources, look for multiple scenarios. There's a little video there about how to add overrides in different areas of the platform.
And then can you also speak to, so somebody mentioned that it's startling what happens for my spouse if I die just before I start my DB pension or CPP, or just before I expect to get an inheritance, etc. Is the way to deal with this to get additional insurance and change it over time? Or how do you think about that?
Yeah, that's actually a really great question. So insurance, we often think about as, protecting for dependents, children, when you're younger, you're working, you've got dependents, younger children. When those children are independent adults, often we think about, not needing that insurance anymore. But the fact is, if you're a higher income earner, if your spouse is a little bit lower income earner, um, even in this situation where, we see a pension reduction, there are different ways to deal with that. You could definitely look at term insurance. As you get older, that becomes more and more expensive. But for Kurt and Lori here, purchasing that at 55 is still relatively inexpensive, especially for the first 10, 15 years. Lori and Kurt might also think about, maybe they should be looking at, even though the lifetime benefit's a little bit lower, does Lori maybe need to choose a 100% survivor benefit option for her DB pension? There's some cost there. It is a lower lifetime benefit, but maybe that's the right decision to help protect for Kurt in Kurt's survivor scenario. Um, in this situation, you might even look at reducing spending. So if it is a very real and big concern that you might pass away significantly earlier than your partner, and based on health or family, that might be a concern. You could also look at the modify retirement spending. So this is almost preemptively looking at if we want to increase the success rate for Kurt here, do Kurt and Lori need to think about reducing spending even though they don't know that this is a concern yet? So that could be one option to look at. It is trading spending. So we're sort of spending money on having a more guaranteed survivor scenario. So it is a trade-off that we're making sort of consciously then within this plan. Um, because of course we don't know when that's going to happen, if it's even going to happen. So yeah, different considerations depending on your situation. Insurance, 100% survivor benefit on a DB pension, maybe even reducing spending just preemptively, just in case.
And this factors all into the sense of like, what is safe spending to you? And this is why we've lumped everything together when you're saying, what is a risky plan? What feels like a safe plan? How do I set my success rate? How do I kind of balance those things? It's really going to depend on your situation, but also what's going to keep you up at night and what's going to
Mm,
make you feel like you're having a safe retirement that you can enjoy.
yeah. Yeah, this is really where, the finance side of kind of retirement planning, personal finances meets the personal side. Um, there is a lot of personal decisions here around how to optimize the retirement plan, what's a good success rate. Very difficult to have any sort of rules or guidelines because it is extremely personal. It depends on your spending, depends on individuals versus couples, assets that you have outside of financial assets, spending flexibility, lots of different considerations. So I hope we've at least painted a somewhat of a picture of where that flexibility might be, what to explore within your plan. But there is obviously a ton of nuance here beyond this as well.
One quick question here, just to kind of clarify again the success rate side. So somebody who's kind of curious, so they're talking about if you're looking at a 40-year retirement,
Mm.
what's being modeled there, but also just looking at saying this clarification was if you have a period of 40 years and the start date is 2008, what returns does it assume beyond 2025 when there, because there's
Hmm.
only 17 years of actual returns?
Yeah, so it's using then for like full 40-year periods. So it would include part of that 2008, but it wouldn't have 2008 as the starting. So yeah, the longer the retirement period, the other thing to think about is that we have fewer 40-year periods that we can test against. Not that I think is a huge concern, but that's definitely something to think about if you have a very long retirement period. Um, yeah, very long retirement periods. you really, really want to think about flexibility outside of investment returns, cash wedges, asset allocation. Really need to think about spending flexibility, definitely thinking about income flexibility. That's one of the key things for a very long retirement period, especially if you're retiring early in your 50s, late 40s. So, if you're looking at the fire sort of goal, think about income as one of those flexible pieces within your plan.
Perfect. Well, we're coming to the end. I know there were a few questions that we didn't quite get to, but please, if you want to ask us questions, the best place to do so is on the Reddit forum. So we have a really active community Reddit forum. I'm just going to drop the link into the chat in case you haven't found it yet. You can leave your questions there anonymously, and we'll weigh in there as quick as we can. We're usually pretty fast with getting some answers up there. So I know that there were also some questions a little bit about what kind of tracking section that we're building, which
Cool.
is a great question. And the thing I just want to put out there, because we don't have time to talk about it too much, is we're still looking for your feedback. So we're still really interested in what people want to see on a tracking section, what you in your retirement or pre-retirement want to see, what feedback that you want to see. So please let us know if there are things that you want to see there. It's not too late to request. It's never too late to request. We love to see feature requests, but definitely let us know what you would be valuable there.
Yeah, and even send us an email at support@advice.com because yeah, we might even want to just jump on a call and then sort of understand, yeah, what are you thinking about when it comes to tracking against your retirement plan? So, yeah, feel free to send us an email, add comments in the Reddit forum. Um, and the other thing I want to share is that feel free to share. You can go to sharing in the left nav. You can share a copy of your plan anonymously in the Reddit forum. There is a help resources that shows how to do that. But we love seeing other people's retirement plans, partially because it just helps other users understand, how to set things up for themselves as well. So again, we've seen hundreds, if not 1,000+ retirement plans. You only see your own, but with the anonymous sharing, we can start to see other people's as well and get a bit of a flavor for that.
Yeah, thank you so much for coming. We really so appreciate your involvement. It's made the platform so much better to hear how you're using it, what's kind of not there yet, what you like, what you don't like. We really, really appreciate that feedback. So thanks for joining us and have a great rest of your week.
Thanks, everybody. See you.